Thinking multi-year with your charitable giving can potentially save you big on your taxes. Ever since the Tax Cuts and Jobs Act, it's been harder for people to see any positive effect from their charitable giving. Unless your total of all your deductions, including charitable giving, mortgage interest, property taxes, and others, is higher than the standard deduction, you won't see any income tax benefit from your donations. You'll simply use the standard deduction instead of itemizing. In 2021, for single filers, the standard deduction is $12,550. And for married couples filing jointly, it's $25,100. That means for most middle and upper middle income donors, a really significant commitment to giving would be needed to impact their taxes, even if they're homeowners and pay mortgage interest. Let's look at an example. A married couple, we'll call them the Smiths, gives $10,000 per year to charity and has mortgage interest and property taxes of $12,000 in the tax year. In this case, they would take the standard deduction of $25,000 because it's greater than their itemized deductions of $22,000, the $10K plus the $12K. They don't see any incremental tax benefit from their charitable contributions. But the Smiths have an opportunity to save a lot of money on their taxes with their charitable giving, even though they don't clear the standard deduction. It's called the bunching strategy. The bunching strategy is when you move multiple years worth of charitable giving to one single tax year and then give nothing the following years. It allows you to itemize way beyond the standard deduction in the year you bunch all your giving and take the standard deduction in the off years. Your total deductions over that multi-year period can be thousands of dollars higher, potentially saving you thousands of dollars on your taxes. To do this, you'd want to give all that you would plan to give to charity next year in this year. Then you'd give nothing next year and take the standard deduction. Let's look at how this plays out for the Smiths. Instead of giving $10,000 per year over the next 2 years, the Smiths could give $20,000 in this year and $0 next year. Let's see what happens to their tax impact. Since they gave $20,000 and they have $12,000 in mortgage interest and property taxes, they itemize in year one with total deductions of $32,000. The next year, they take the standard deduction of $25,000 or so. Over the 2-year period, by bunching, their total deductions are $57,000 or so instead of $50,000. At a 20% effective federal income tax rate, that extra $7,000 in deductions is worth $1,400 in savings. Awesome. Now, you may think it'd be tough to forsake giving to charity for a year. I agree. That's where a donor-advised fund like CharityVest comes in. If the Smiths put their bunched $20,000 of giving into CharityVest this year, then they can grant it out slowly from their CharityVest fund to the charities they want to support over the next 2 years. Their favorite charities never see a change in their support. A lot of people are starting to bunch and the savings are significant. The more significant your giving or mortgage or property tax obligations, the larger the bunching effect can be. For example, if the Smiths gave more, let's say $20,000 per year, bunching would increase much further because they would clear the standard deduction over the 2-year period even more. Being tax smart with a donor advised fund can save you a lot of money, and more importantly, help you send more money to charities, increasing your impact over time.